Let's get straight to the data. The single most important thing for silver stackers to understand this week is the growing gap between paper price and physical availability. In this video, I'll show you the exact numbers from COMEX, the premium environment at major dealers, and give you my clear view, bullish or bearish, for the next 2 to 4 weeks. First, here's the hard evidence. Silver spot price closed Friday at $32.18 per ounce, down 3.2% from last Monday's open at $33.24. That's a 1.06 drop in 5 trading days, with the heaviest selling pressure coming Wednesday following stronger than expected retail sales data. Volume was elevated, roughly 15% above the 20-day average, which tells us this wasn't just position rolling but actual liquidation. Now look at COMEX. Total registered silver, that's the metal available for immediate delivery, currently sits at 31.7 million ounces as of yesterday's warehouse report. That's down from 33.1 million ounces at the start of February, a decline of 1.4 million ounces in just 10 days. Eligible silver, which is stored but not marked for delivery, stands at 278 million ounces. The ratio matters here. Registered is 10.2% of total COMEX inventory. Meanwhile, physical premiums are telling a completely different story. American Silver Eagles are trading at $6.50 to $7.20 over spot at major online dealers. That's a 20 to 22% premium. Canadian Maples are running $5.80 to $6.40 over spot, roughly 18 to 20%. Even generic rounds are holding $3.50 to $4.20 premiums, which is 11 to 13% over spot. 3 months ago, those same generic rounds were $2.80 to $3.20 over spot. What this data normally means is simple. Paper market participants are selling. Physical market participants are not. So what's actually happening here? This is a classic physical versus paper divergence, driven by two simultaneous forces. First, the futures market is responding to macro data. The retail sales print came in at 0.9% month over month versus expectations of 0.3%. That pushed the 10-year Treasury yield up 8 basis points to 4.51%, strengthening the dollar index by 0.5%. When the dollar strengthens, commodities denominated in dollars mechanically face selling pressure. The algorithmic funds that dominate COMEX futures don't care about silver's industrial demand or monetary properties. They care about the dollar correlation, so they sold. But look at what's happening in the physical market. Dealer inventory turns are accelerating. When I check availability at the top 5 online bullion dealers, delivery times for Silver Eagles have stretched from ships in 1 to 2 days to ships in 5 to 7 days over the past 3 weeks. That's not a supply chain issue, that's demand absorption. The mints are producing, dealers are ordering, but the products are moving off the shelf faster than they're being restocked. Here's the key technical divergence. The futures market is pricing in lower prices. The options market shows elevated put buying at the $30 and $31 strikes for March expiry. But the physical market is behaving like supply is tightening. Premiums don't contract when demand falls. They're sticky upward, yes, but they compress when buyers step back. We're not seeing compression, we're seeing expansion. Compare this to gold for context. Gold spot is down 1.8% over the same period, a more modest decline. Gold premiums on American Eagles are 3.5 to 4% over spot, basically unchanged from January. Gold's registered COMEX inventory is at 8.9 million ounces, also relatively stable. The divergence is specific to silver. That tells me this isn't a broad precious metal sell-off. It's a futures-driven silver correction meeting physical demand that refuses to follow the script. One more data point. The gold-to-silver ratio hit 89.5 yesterday. That's the highest reading since late December. Historically, when this ratio expands above 88, it tends to revert within 30 to 45 days. The mean reversion can come from gold falling, silver rising, or both. Given the physical premium structure, I'm leaning towards silver leading any rebound. Here's what to watch and what to do. Most likely scenario: silver consolidates between $31.50 and $33 for the next 7 to 10 days. The FOMC minutes release on Wednesday will set the tone. If the minutes show a more hawkish tilt, we could test $31. If they lean neutral or acknowledge disinflation progress, we likely bounce back toward $33.50. The key level to confirm strength is a daily close above $33.80. That would break the recent downtrend and open the door to a retest of $35. The physical market will lag by 48 to 72 hours. If spot rallies back to $34, don't expect premiums to drop immediately. They'll hold elevated for at least a week after any price recovery because dealers need to rebuild inventory at the new higher level. Your action plan as a physical stacker. 1. Monitor the COMEX Daily Warehouse Stocks Report. You can find this on the CME website under Metals. Watch the registered category specifically. If registered drops below 30 million ounces, that's a significant psychological threshold. It doesn't mean delivery default is imminent, but it does mean the cushion is thinning. 2. Track premiums across 3 dealer types: major online dealers, local coin shops, and eBay sold listings. If you see premiums expanding another 2 to 3% over the next week while spot stays flat or falls, that's confirmation of the physical tightness thesis. Right now, eBay sold comps for Silver Eagles are running $39 to $41 per coin. That's a $680 to $880 premium on a $30 spot price. Retail buyers are paying up. 3. If you're looking to add to your stack, set a buy limit at $31.25 spot. That's a 50% Fibonacci retracement of the January rally from $29.80 to $34.20. If we get there, you're buying near technical support with elevated physical demand as a tailwind. Don't chase the premium. Buy standard products: Eagles, Maples, generic rounds from known mints. The premium gap between premium products and generics is wide right now. You're paying for brand, not metal. 4. If you're selling, wait. Unless you need liquidity, there's no reason to sell into this dip with premiums this firm. The bid-ask spread at dealers is roughly $2 per ounce. You'll lose that spread immediately. Better to wait for a spot recovery to $34 or higher, where your sell price improves by $2 to $3 per ounce before factoring in the spread. To recap, the data shows a 3.2% spot decline in silver over the past week, driven by dollar strength and futures selling. COMEX registered inventory dropped 1.4 million ounces. Physical premiums expanded to 20 to 22% on Silver Eagles, the widest spread in 3 months. The driver is likely a macro-driven paper market correction meeting sustained physical demand. My view is cautiously bullish over the next 4 weeks. Your job is to watch COMEX registered inventory, premium trends, and the $31.25 to $33.80 spot price range. If this calm, data-driven approach is useful, subscribe. Let me know in the comments. Do you see this divergence as a buying opportunity or a warning sign? Drop Currency T below. Stay disciplined. Trust the data. I'm T for Currency T, out.